That's where today we'll kind of walk through the 4 different ways to invest in real estate and break it down to help you understand the options you have available, as well as what is the best fit for you if you want to get into real estate.
It's probably best to start off with like the do-it-yourself path, or I mean, the path that probably everybody thinks of right away is buying a house and just renting it out.
Absolutely. And many people start with the do-it-yourself. You buy the property, you're the boss. You can control what happens. You pick the market, you pick your lenders, you conduct the renovations, you bring in the tenants, and you have full control. However, that also means that you get the phone calls, the surprises, and you have the learning curve.
Who would want to go down that path for like real estate investing?
That's a great question. So it typically fits someone that wants to be an operator. They're willing to put in 10 to 20 hours a week in the beginning, and they want maximum control and don't mind trading time for the potential higher upside. There's also hands-on tax benefits like depreciation that you can take advantage of to really minimize your tax liability. But if you're a busy surgeon, an attorney, or an executive with kids, and with a 60-hour work week, a do-it-yourself ownership can really turn into a second career if you're not careful. The pros are you have control, you can force the appreciation on the property, doing that through renovations or better management, making it perform a lot better than maybe it was prior to you buying it. And you have the strong tax benefits if you structure it correctly. The cons on the other side are it's time intensive. Your risk is concentrated in 1 or 2 buildings. And if you pick the wrong manager or underestimate repairs, your passive income could turn into an expensive night hobby.
So it could potentially turn into like a big liability.
Yes.
Time or okay.
And many of us have been there in the early days where you have rose-colored glasses and you look at all the positive things and you're not thinking about what could go wrong and planning for those repairs. And so with experience comes that wisdom. So joint ventures is where you or one or more partners buy a deal together, and you get to share the decisions, the capital, and the upside. For example, your friend is an operator and you bring a chunk of the capital and some oversight. You both sign the loan and you both have say in how that property is managed.
Who do you see primarily going this route?
So this is people that want more influence than a pure passive investor. You trust the specific operator because they'll be running the property on a day-to-day basis. And you're okay with being active for 2 to 5 years as you're holding that property. It's still a relationship business. You have the operating agreement, you have decision rights, you have what happens if we disagree clauses, that those things all matter more so than just the pretty photos of what a property looks like.
Is JV where it like starts to get into like larger properties?
Absolutely. Yep. As you bring more people together, you're able to take down bigger properties and buy better assets than when you're purchasing a loan. But you also carry the partnership risk and some of the workload. So for a truly starved professional, this often ends up being too active unless the roles are very clearly defined on who's doing what in your joint venture.
And then as far as like you personally, have you done both?
Yes, when I started my real estate career 20 years ago, I initially bought on my own, then I went joint venture, and I've actually invested in all 4 of these ways. So definitely pros and cons, just depending on where you are in life and what matches your lifestyle and your goals.
Do you have any personal favorites? Maybe we haven't got to it yet, but like, is there one that you most often lean towards?
Yeah. These days, I definitely lean towards group investing. The primary reason is we're buying much larger properties. There's a lot more diversification when you're buying 40 units versus when you're buying a single family home. If you have a single family home and the tenant leaves, now you have 0 income. If you have 40 units and a tenant leaves, your impact to the income is very nominal. And so I really focus on larger properties that we're buying and newer. I used to buy much older properties, and they're just more unpredictable. And so the newer the property is, the less that typically goes wrong, and or you can predict when you are going to have maintenance or need to replace things. There aren't as many surprises, I would say. And what that does for investors is when we put together financial projections, we have a much higher confidence level that we're going to hit those projections because there aren't as many surprises.
Are there any trade-offs going like joint venture versus do it yourself?
Yeah, so with joint venture, you do have the opportunity to work with others. And so the one thing I liked in going with joint venture is I always had partners. And so if I was out of town and something happened, my partner was there that they could address something. And so I didn't need to worry that it was all on me. And whether that was from a time perspective, from a capital perspective, in investing to purchase the property, and even from a risk perspective. So there's definitely pros and cons there. Now you're also sharing your return with others in the JV side. But I always figure a slice of a watermelon is a lot more than a single grape. And so I'd rather invest with others and get a bigger slice than investing alone and having a smaller return.
Going like the third path is REITs, right?
Right. Yep. So investing in a REIT is, said simply, you're buying stocks that own real estate. So you buy shares in your brokerage account like buying any other equity. And what's nice about that is it's very easy to buy and sell. The market is open 5 days a week. And so you can go in and buy and sell those shares whenever you want. You're also diversified across many properties and many tenants, and there's zero operational involvement. It's not taking any of your time. On the flip side, some of the cons are that you're exposed to stock market volatility. So when the market corrects significantly, you're feeling that impact. You also have different tax treatment, and you don't directly control things like depreciation and cost segregation, nor do they typically flow through to your tax return. And that's something that especially high net worth individuals really like to have the tax advantages through the other methods that we're discussing today. And the last thing is you just don't have much say in decisions on how those properties are managed. Again, you're buying the stock that owns the properties. And you also don't get the tax advantages when you're investing in a REIT that you would in the other methods. And many times that's what high income, high net worth individuals are looking for, is they're like, I make a lot of money on my W-2. The last thing I want to do is have an investment that causes me to pay more taxes. So by investing in real estate through the other three methods that we're talking about today, there's typically tax write-offs that investors can take advantage of because it flows through to their tax return. And of course, everyone's situation is different. Each investor needs to work with their financial advisor and CPA to see how that would look for them on their tax return. But there is a very nice tax benefit for investing in real estate. And that's why you see a lot of ultra wealthy people. They all own real estate. It's very interesting once you start digging in and learning about it. So group investing, sometimes referred to as syndications, is really where you're buying a property or a portfolio with a group of people, and you have a professional that is doing the work on it. So they're sourcing the property, they're underwriting the property to make sure that it's a deal that we want to proceed with. They raise the capital from a group of investors. They sign on the debt. They execute the business plan on a day-to-day basis and handle all of the operations. You simply invest as a limited partner. So you're completely passive. So for someone making $200,000 or more with kids, this is often the sweet spot. And it's a sweet spot because you get direct ownership, exposure, and you get tax benefits. You don't have to find the property, negotiate the loan, or manage tenants. You can choose individual deals that match your risk, time horizon, and tax goals. And so you really have a lot more control around that decision making, but yet someone else is doing all of the work for you.
I mean, this sounds great. Why wouldn't, like, say, everybody get into it? I mean, other than the people who maybe just want to buy one property and control it themselves, what would maybe like prevent everybody and anybody from getting into this aspect or this path?
That's a really good question. Typically, private placements are limited to people who are accredited investors. So that's someone that's making $200,000 or more a year, or have a net worth of $1 million outside of their equity in their home. And so the reason that there are those rules is our government's way to protect people from investing in things they don't understand or don't have the net worth to navigate well. And so typically you see high net worth people that are investing in these private placements. And that's where the tax advantages are so important. And it provides them a vehicle to shelter some of their taxes that they might otherwise have to pay each year.
It's maybe harder because you have to have capital already, or maybe larger than maybe you would have to if you did do it yourself method.
Right. Yep.
Okay.
Because if you're buying properties by yourself or doing a joint venture, you can buy much smaller properties and buy single family homes and put very little down. When you're doing private placement and group investing, you're typically purchasing portfolios that are multiple $1 million in value. And so the amount that you're putting down on these properties, you want many people to come together to come up with that down payment.
What should somebody who is an accredited investor, meets those qualifications, what should they scan for in a potential offer? Or maybe they want to find a group or a syndicate to work with and do some real estate investing. What should they look for?
Yeah, that's a great question. So what you'd want to look for is the asset class that you're investing in and the market, and why is now a good time to invest. You want to make sure that there's many different asset classes that you can invest in. And so you want to invest in one that resonates with you. You also want to make sure you understand their business plan. Is this a value add? Is it development? Or is it stabilized income? And how is the operator creating value in that investment? You want to make sure that the timeline is aligned with your timeline, because your capital is going to be locked up for a period of time. That may be a 3 to 5 year time horizon, or it may be up to a 10-year time horizon. When you invest, you want to make sure that you don't need your capital liquid during that time. You also want to make sure you understand the economics of the deal. So is there a preferred return that is paid out to investors first before the operator receives any financial benefit? How are profits split? What are the fees to the operator? And what is the target cash flow on that investment? And each investment is different. You just want to understand how the financials are going to be split between limited partners and general partners. And you also want to understand the downside plan. So when things don't go according to plan, what are the debt terms? What are we holding for reserves to navigate those surprises? What happens if things go sideways? And the last thing that I look for is their track record and how they communicate. Like, what have they actually done? And how often are they going to report to investors, so investors know what's happening with their property? Private deals are not liquid, and so they're not for everyone. But for a high income earner who wants to reduce their tax income and simply avoid another job by managing property themselves, this path often gives the best outcome to effort ratio. And that's really why this ends up being attractive to many high income earners.
What does like the typical return look like?
So typically you're seeing anywhere from 12 to 30%. Again, it depends on the asset class. It depends on how they're creating value. For development, you're going to see developments on the higher end of that because there's more risk associated with a brand new development versus purchasing a property that is stable and running well. There's a lot less risk with that, and the returns are lower as well. So kind of just depends on the asset class that you're investing in.
What has maybe been some of your personal experience with the group investing route?
Yeah, so I lead group investing with people locally here, and am working with out-of-state operators as well. Our experience has been fantastic. I'm a CPA, and I tend to be conservative in nature, which is good and bad. My financials are, our performance is really high compared to our projections. Some of the learnings is that our projections have been historically more conservative than they should have been. However, the win is that our portfolios are performing better than we anticipated because of that. So I always prefer to underestimate the performance on a property, because when it does better, it's just results in happy investors. So our investments have been going really well. We communicate quarterly to all of our investors. So we send out investor updates quarterly. We send distributions on an annual basis or quarterly basis, just depending on the property that they're invested in. And at any time, investors can reach out to me directly. And they also have access to all of the financials in a secure portal. So on any given month, they can log in, they can see how the property is doing, have all of that information at their fingertips. And we have an independent accountant that does all of our accounting to make sure that we have proper segregation of duties and clear transparency in all of the financial transactions. So as a CPA and former auditor, I want to make sure that everything is buttoned up, and that everything we do is ethical and transparent to all of our investors.
Can you maybe break it down or give us simple way to choose among the four?
That's a really good point, because of these four, they typically resonate with people at different stages in life. If you want control and are willing to put in the work, you really want to look at do it yourself or JV. If you want liquidity to be at a maximum and simplicity, really consider a REIT, where you can invest, purchase, and sell stocks whenever you want, because that's your highest liquidity and there isn't any work associated with that. Lastly, if you want passive income, tax advantages, and expert execution without having a second job, learn about private group investments or syndications, and if appropriate, private placements. So whatever you choose, make sure that it fits your time, your tax situation, and your temperament. Interview operators, ask for references, and by all means, always consult your financial advisor and CPA, as they'll have input into what is the best route for you to take.
Awesome. Well, thanks, Jody, and thanks for giving us that breakdown and sharing what the different ways are.
Absolutely. Thanks so much, Ethan.